All right. Welcome, everybody. Just making sure everything is working here properly. And if I could just test you guys in the chat, if you could read the chat, I'm going to throw in a happy Thursday message here. If you could see that, if you could just comment that you could see that and that you could also hear me. If I could just get a confirmation. All right, I'm testing on my phone there, so I was able to see that you guys can, in fact, hear me. We're going to start here in a few minutes, but just want to welcome everybody. I got to look up here to the camera. I'm looking at here on the screen, but I want to welcome everybody here talking about war and money. Obviously, we know what has been happening here between the United States and Iran as of late. And so wanted to put together this webinar for everyone out there to learn about what the impact has been in the past on the markets here in the US when war has taken place. So I'm going to go through all of that with you here today. Matt, you are welcome, sir. Thank you for being a supporter of the channel. I appreciate that very much. And it's a lot of fun for me to be able to do this. So I enjoy it. So the fact that you appreciate it makes me happy. Pam, you are welcome. Thank you so much. Thanks for being here. All right, well, we will get started here. I want to be respectful of your time here this evening. But again, welcome to War and Money. This is a webinar here from Courage Pays Better Than Fear Trading. Wade, hello, sir. And again, this is a very uneasy time in our country because of the war that is taking place between the United States and Iran. So there's the component of just safety, security, but then there's also the component of how does this impact finances? How does this impact the economy? And what does it mean for your money, for your investments, for your retirement accounts? Because we know that when things like this happen, there is a negative impact. And so I want to walk you through what that looks like based on historical examples from the past so that you can see when incidents of war like this have occurred before, what played out. So what I've put together is just a few slides here and some research to show you what has transpired. We're going to look at the Iraq war. We're going to look at the Gulf War. We'll look at what happened with Russia and Ukraine when that first happened, and just to see the impact, and then what happened months later. And then we'll also talk about, too, with ceasefires, being that we recently had a ceasefire announced, what typically happens then? What happens a few weeks or a few months after? And so having that information, it could just help you make more informed decisions about your money. If you're a trader or an investor, it can help you make better decisions there, but it can also give you some peace of mind if you are of a retirement age, or if you are looking to retire soon and you're seeing your account drawn down. It could just give you some peace of mind of, okay, well, how long does something like this typically last? So we can answer all those questions for you here this evening. And everybody else that I didn't say hello to, just want to say hello to you guys now and thank you for being here. I know the light's a little bright here, but we will make it work. So I'm going to pull up the slides here and get these shared, and we are going to jump in. Let me just make sure that you can see that here on the screen. So give me 1 second, and I believe we are good. There's a little delay here, so I'm waiting to see on my monitor over here the slides show up. And that's why I'm pausing here a little bit. And so I'm just going to go ahead and launch in, and hopefully that delay catches up. But here we go. War and money and how conflict shapes your portfolio. We're going to talk about markets, geopolitics, risk, and get into what typically happens when events like these occur. And so we're going to begin by talking about the anatomy of a war shock and what happens at first when a war is announced, when this first hits. And let me just clarify, can you guys see this, the slides? All right, it looks like we could see them. Let me just test here. You guys. Okay, so we can't see them. All right, let me reshare this here. Oh, you can see them now? All right, let me pause. I'm going to pause and wait to make sure that they're showing up here. All right, we're good to go. All right, live streams, guys, have been my biggest challenge here in getting these to function properly. So bear with me. I'm still learning the art of the live stream. But anyway, let's talk about the anatomy of a war shock and what typically happens whenever a war is first announced. Well, the first thing that typically occurs, and this is with any negative catalyst in the markets, is whenever it first hits, there's an immediate negative reaction or a panic sell-off where everybody just runs for the hills. They dump their positions. And you could see a significant drop in the broader markets. And when we're looking at the S&P 500, that's typically what we look at whenever we're gauging how the broader markets are functioning. We could see a drop anywhere from 5 to 12%. And if you look at this current instance of a war, it started right at the tail end of February and has been transpiring ever since. And you can see that 5 to 12% decline happens within the matter of the first 5 days. So that drop is pretty quick and early on in the process. If you look at the broader markets today and the drop that we had off of the announcement of the war, you saw the S&P 500 drop about 9.8%. Now, a correction is defined as a 10% decline from the recent highs, in this case, all-time highs of 7,000 on the SPX. We would have to have dropped 10 full percent. We got close. So technically the number wasn't 10%, but we were close enough. We were a quarter point away. But when you look at the other broader markets, like the NASDAQ or the Qs, which represents technology, that corrected over 10%, around 12%. IWM, which is the Russell Small Cap 2000, your small cap sector, that corrected over 10%. The Dow Jones Industrial corrected over 10%. And for those in the crypto space, that has been in a bear market for quite some time. So really, all of the major spaces in the markets have corrected, have come down. And we saw that selling accelerate when the Iran-United States war first began. So there's the outbreak. The next stage of the war shock with markets is whenever you have escalation. And this is where you see volatility increase. Now, when we talk about volatility in the markets, basically what that represents is fear and uncertainty. And if there's one thing that I want you to take away from here tonight, is the stock market, the bond market absolutely hates uncertainty. When it does not know, or at least have a good read on what is going to be happening the next 3, 6, 12 months, it doesn't like that. And when that happens, volatility spikes. And there is an index that you can follow to see what the level of volatility is in the market. And it is known as the VIX, the VIX. And so typically what you see during escalation is the VIX will spike anywhere from 30 to 80%. And you might be asking, well, how much did we spike on the VIX during this recent conflict? And the peak so far, because we're still in this process, was 35% on March 9th. So we've had a pretty significant spike, but not to the 80s, which it has been before. And typically during escalation, you will see defense stocks rally. So these are makers of weaponry or different artillery machinery. And in this particular case, we've also seen something else increase in price. And does anybody want to take a guess of what that is? I'm sure that you guys know what has spiked in price here recently as a result of this conflict. If you want to plug it in the chat. Oil, liquid gold, yes. Yes, oil has spiked. So as a result of this conflict, it's not just defense stocks rallying, it's been oil, energy prices, natural gas. We've seen massive spikes, crude oil, domestic oil companies like ExxonMobil, Occidental Petroleum have all just spiked in their value. And that is related to what is happening. All right. So keep that in mind. This is all situation-based elevation in prices. And so some of you who are looking at oil, oh, oil's just going up, and you want to FOMO and buy into it. Just remember, this is going to stay elevated eventually. And who knows when? We don't know how much longer this is going to last. Stay at these elevated prices permanently. And it will eventually come back down to its normal level. So we just want to keep that in mind. But we have seen that increase based on the war escalating. And then from escalation, you have a stalemate. And this is where markets stabilize and they begin to price in the war and what's happening. And we're seeing a little bit of that now. And on those big moves to the downside that we were seeing when we were around those 10% levels, below 10%, the market started to truly fear for the worst, the fear for ground invasion, that this could be a longer lasting war, that because of these spikes in oil prices, we were going to see an increase, a continued increase in oil prices and energy prices, which then drives inflation higher. And the reason why that scares the market and the bond market is because higher inflation not only puts pressure on the consumer. I'm sure we are seeing this at the gas pumps. Now I have an EV, so I'm not impacted by that too much. My wife has a gas powered truck, but we are seeing that gas is creeping up. That puts a lot of pressure on the consumer. But the other component of it is, as energy increases, the price of energy increases, it increases inflation, and then the Federal Reserve cannot lower interest rates, and in fact may be put in a position to where it has to raise them to keep inflation in check. And all those things just put more undue stress and pressure on the consumer, and it could eventually result in a recession. So that's why a longer duration situation with this conflict with Iran could have some significant negative repercussions for the United States economy, right? So there's interdependence between all these things and as they function. So that's why this recent announcement of the ceasefire for 2 weeks, which brings us to resolution, this is where a rally will begin. Now, this ceasefire that was announced, and we'll talk about that more here in a second, it's a 2-week period. It ends April 22nd, and that's when a deal has to be done or the fighting will continue. But when we see these resolutions happen, the historical precedent of a rebound is plus 15%, right? That's no small potatoes. And that happens within 6 months of a ceasefire. So the takeaway here, and just keep this in mind, if you go back and look at any war that happened, the majority of them are of the shorter term nature. Now, there have been conflicts that have been long and drawn out, but those are in the minority. But they all do eventually end. And when they do end, there is prosperity that follows. There is a push higher that comes in the market. Okay. So that lays out the anatomy of a war shock. Now, if we just look at historical market reactions to major conflicts, I'm not going to read through all these for you. You guys can see this, and this video will be posted where you can check it out on YouTube. And I'll also clean this up a little bit and put a video on the channel. But you could just take a look and see at the different major conflicts that have occurred and what the initial drop was from the start of that conflict, the time to the bottom, and then what the 1 year return was after the fact. And really what I want you to look at, and what's most important here to look at, is look at the 1 year return after. Look at the 1 year return after, right? Just focus on those numbers. Now, I know if you look at 2001 following 9/11 and the military escalations that came out of that, that was following the dot-com bubble. So we were in a period of an economic downturn at that time. And so the 1 year return after 5%, we're not in similar conditions right now. We have been in a bull market since 2023, but you could see the 1 year return following these major conflicts, right? 15%, 1941, after an initial drop of 7.4%. Or you come over here to 1990 in the Gulf War, a 13.6% initial drop. And that took about 3 months for the bottom. And then the 1 year return later, 29%. So the takeaway here is, yes, there is short-term disruption to the market as a result of these events. But typically, historically, 1 year later, we do see an increase in returns. Now, crazier things have happened, and this could be something beyond the scope of some of these. You could never say never, but just based on what has occurred, we can see that there has been a uptick in markets following these types of events. So I wanted to with you as well. And then we could look at sectors, winners and losers during war. And what's interesting is we're not seeing the typical winners here as winners right now, just as we're not necessarily seeing all the losers on this list as losers right now. It's a little different in this war between the United States and Iran, but it is important to just familiarize ourselves with what typically runs during these time and what typically takes a step back, because unfortunately, more than likely, this will not be the last conflict that happens here in our time, in our timeline on this earth. And so just by knowing this, we can be educated and informed to have an idea of what's going to be impacted in the markets. But typically, winners and losers during war, the typical winner, there's no surprise here. Defense and aerospace, you could see the typical average increase during a conflict. Company like Lockheed and Martin comes into mind. Energy, oil and gas, obviously we're seeing that significantly right now because of the restriction of oil transport in the Strait. And I always butcher saying Hormuz. I struggle with pronunciation. It's like my brain. So every time I say Hormuz. So with the restriction of the Strait, that has definitely put pressure on energy prices to the upside, especially oil, especially natural gas. So we've seen those as typical winners. Now, I will point this out. Cybersecurity on here is typically a winner in wartime environments. However, right now, one of the unique things that's happening with the advent of AI is a lot of software stocks have taken a beating especially cybersecurity stocks, because of an AI company called Anthropic, who is basically showing that they're able to do what a lot of these cybersecurity companies can do with their AI models. So cybersecurity actually is not performing very well right now during this time, but typically in the past they would. It's a disruption that is a result of AI. And then you can see that most of the time too, gold and precious metals perform well during war. We haven't seen that the case here with this conflict. However, prior to this conflict taking place, you did see gold, you did see silver, copper, all the other metals were really just on a tear at the beginning of the year. But that really hasn't held true here as of late. And then typical losers, airlines, tourism. Obviously, you think of the energy prices for travel, emerging markets, India, Brazil, South Korea, who were performing well. Money's going to be pulled out of those emerging markets as people look for safe havens to put money. Real estate, international trade, consumer discretionary as consumers pull back from spending. So those are typical sectors that during the war. So let's talk about this ceasefire, because we talked about what happens when the war initially hits. We talked about the digestion of it. We talked about the stalemate when the two sides are butting heads and are not willing to give an inch. And then we get to the point where we start talking resolution. And within that, we start talking about a ceasefire. And a ceasefire, at least a 2-week temporary ceasefire, it's been described as a fragile ceasefire. Talks are to begin tomorrow in Islamabad to hammer out a deal that hopefully is done by April 22nd. That's this next deadline. But what has happened in the past with ceasefire? So we can drill down even further, not just war, but what happens with ceasefires. And so what does history tell us? Again, there is a playbook that's left behind that we can look at for clues in terms of what we can expect to come next. And we're seeing some of this. So the first thing is an immediate relief rally. Well, the last 2 days, we've had a relief rally. And you can see here, markets typically jump 3 to 8% within 48 hours of a credible ceasefire announcement. And you can see here, defense stocks often give back gains quickly. We saw that happen with oil. Oil dropped drastically when this 2-week ceasefire was announced. And we saw the SPX yesterday jump up about 2.3%. Today, the markets were up again. The SPX closed above its 100-day simple moving average, and now it has room to continue to climb. Doesn't mean that we're going right back up to all-time highs, but that relief is bringing some enthusiasm back into the market. Reconstruction boom. Now, we're not here yet because this would be a full-on finalized resolution, a full-on permanent ceasefire. And when you talk about a reconstruction boom here, you're talking infrastructure, materials, rebuilding, and industrial sector surge. And we're not at that point yet, but that could be something down the road that once this is finalized, you could see those sectors pick up. Energy price normalization. We could see gas come back down to the levels they were before this conflict, because again, significantly elevated. We have seen them drop back down, but again, it's still you can't give full 100% confidence in the ceasefire because there are still uncertainty surrounding it. So this ceasefire right now, honestly, is tenuous. It's a step in the right direction, but it does not mean that a full-on resolution is yet on the table for the 22nd. But once that is cemented, let's say that by the 22nd, which is, we still have 12 days before we get there. If that is solidified and that resolution comes through, then we will see, if history holds true, we will see a sustained rally come out of that. And you saw the slide that I showed you just a bit ago of what those what those returns look like. And so it's just a matter of time and waiting it out. All right. So a couple more slides here, and then I do want to jump into the charts, and we could take a couple questions here and talk through some things. And I wanted to talk about how this impacts your portfolio. So you might be saying to yourself, oh, well, this is all well and good information, but what does this mean for me and my money? What does this say? How is it going to impact me on a day-to-day basis? Well, we've already talked about inflation and how, especially with this conflict, because oil is involved and because oil is skyrocketing, that drives up energy costs, it drives up food costs, commodity prices, and that raises inflation. So it erodes your purchasing power, and the power of your dollar becomes less. And the other thing to keep in mind too, like I said earlier, is if inflation increases, the tool that the Federal Reserve has to combat that is increasing interest rates, which can then increase what you're spending in interest if you have loans or if you use a credit card, and it adds more pressure to the consumer. All right, so that's the first thing. But the other part of that, when you're talking about your portfolio and your money and your longer term investments, your Roth, your 401k, is a higher inflation, higher interest rate environment. And as rates are increasing, that is not good for stocks. It's just not. It's not good. So the sooner that can be tamed and brought back down, inflation can be brought back down, the better for your portfolios. Supply chains are disrupted as a result of war, which can impact you as well. You can see here, conflict zones disrupt shipping lanes. The Strait, I'm not going to pronounce it, manufacturing hubs, raw material exports, and that impacts tech. It impacts auto, retail, and then we can see currency risk. And the U.S. dollar strengthens, but that doesn't mean it extends your purchasing power of that dollar. That actually it's the dollar in the sense of the actual currency, but not is how far you can stretch it for yourself as a consumer. And then the last component here, credit risk. War-affected sovereign debt can collapse. Emerging market bonds are also especially vulnerable. And again, it's just the interplay of all these factors globally that happen and come under the microscope as these types of things play out. And so the best case scenario is for some type of conclusion or resolution to be achieved, because again, the longer this goes on, the greater the impact on inflation, the bigger the disruption to supply chain, the stronger that the dollar becomes, but the weaker your dollar and your wallet becomes, and the greater risk of credit defaults happens. And it's just an all-around situation. All right. So what are the most likely outcomes here for 2026, just based on what we're seeing, where we currently are? And so I'm a big believer in breaking things down by probabilities and what has happened in the past. And based on what we're currently seeing, we have 3 likely scenarios for what plays out here. Okay. And this is just based on what we've seen in the past and what we're currently seeing. So there's probability A, the first probability. This is 40%. So this is where we're trending to right now: negotiated peace and a ceasefire. So we're in that 2-week period. Ceasefire, relief rally. We see rotation out of energy and oil, out of the defense stocks, and risk on appetites come back into other stocks that have been beat up. We see energy prices fall. We see inflation start to come back down. You don't hear people talking about interest rate increases being back on the table. You start to hear talks of interest rate cuts come back on the table. And all is trending in a positive direction. That's the scenario that is going to be best for the economy, right? It is that direction. Scenario B is, again, 40% probability here. This is a prolonged stalemate. So that's more of this. We're just kind of stuck here, butting heads, and markets stay range bound. The volatility stays elevated. The oil prices stay elevated. They're still spending on defense. So there's a tailwind in those markets. And there's signs of hope followed by a few steps backward. Signs of hope followed by a few steps backward. But eventually, if you're in scenario B, you're going to move to scenario A. So basically, if we linger a bit in scenario B, it's not necessarily a bad thing. It just means that this is going to be more prolonged and drawn out. Now, that does increase the chances that we could see greater weakness in the economy, could see a recession. So you don't want to be in scenario B for too long. You want to get to scenario A and push it all the way through to the final resolution. So really, you could see 80%, it's 80% likely we are in either A or B. And I would say we're sure we have a negotiated 2-week ceasefire right now, but we're kind of in between an A and the B because there's not much conviction that this ceasefire is going to result in a true resolution. And then the final scenario. So this is a 20% probability, and this is escalation and broadening conflict. And this is the worst case scenario. So this is where you'll see a sharp sell-off where 10% looks like nothing. You're talking 20% or more. You're seeing oil spike significantly. You are seeing bonds spike. You are seeing flight to safety. You will see precious metals spike at this time. And unfortunately, what would happen if we go this route and the war escalates into something that lasts for a significant period of time, the risk of not just a U.S. recession, but a global recession because of oil and energy increases dramatically. So again, that this would be the worst case scenario, not to mention world peace, obviously. So these are the three scenarios that we have to watch for. But with all that said, despite that, even if it is scenario C, keep this in mind that eventually it will come to a resolution. And if it's a worst case scenario where it's 6 months, 9 months, a year, over a year, there will eventually be a resolution and markets will eventually rebound. So if your portfolio is down and it happens to be a longer duration type of event, your portfolio typically will rebound. It's just going to take longer for it to do it. Now, if you know more advanced strategies like using options to protect yourself for income strategies, those types of things, you can soften some of the blow and actually profit as these things happen. But history shows us that markets do come back. All right. And I did put together this slide too here just to show you some of the statistics from the ceasefire that was announced here between Iran and the United States just a day ago, just to go into some of the details here. So it's a 2-week ceasefire. Again, the deadline for this will be April 22nd. So make sure that you have that marked out on your calendar. Pay attention to what's being discussed to hear if progress is being made. The key condition is that Iran opens the strait. And we heard some rumblings today that Iran said that the conditions of the 2-week ceasefire weren't being followed, so they were going to shut down the strait again. So you're still hearing that back and forth, which shows that this thing is not yet ready to be over. But you can see the reaction, just after that first day of how the S&P went up 2.5%, the Dow 2.8. It's the best day in 1 year. The NASDAQ, and you can see how far crude oil dropped Brent crude, what happened with the 10-year treasury, gold. And so you could see that there was a positive response across the board in the market. And then historical ceasefire. So what do we typically see historically with ceasefires? So you can see here historically, the typical initial relief rally is anywhere from 3 to 8% increase, 2.5% for this this ceasefire. Oil price drop. So typically 5 to 10%. It was a 16.4% drop in oil. So that was unprecedented. Meaning there was no instance of oil dropping that much that fast in history. So it was a historical event. But my take on markets today, or moves, are so exaggerated with the advent of social media and just the speed at which trading and investing can take place. So I think that plays into a lot of that, but that's a massive drop. Trust level is typically moderate with historical ceasefires. The trust level right now, very low between these two countries. The durability outlook, typically when a ceasefire is announced in the past, it usually holds. Again, we're very uncertain right now. And then we know that Lebanon has been a point of contention too. That being a part of the negotiations, and there was an announcement today that Israel was going to begin directly negotiating with Lebanon. So that is going to have, and it did have a positive impact today. And again, just looking at the probabilities here, 50% likely that the truce holds. Again, those in-person negotiations will start tomorrow. And then you could see here a partial breakdown. So really anywhere within that truce holds or the partial breakdown is okay, because that's ultimately going to lead to a resolution. But it's that 20% where there's a full collapse and the war resume that's going to lead to just the overall negative outcome. So, but here's the main takeaway, and this is really what I wanted to drive home. Number one, I just wanted you to see that. What did you just see historically when things like this have occurred in the past? What has happened? There's a textbook sequence of events that happens. There's always your initial drop, right? When things first happen, there's always a spike in volatility. There's always an increase in energy costs. Defense stocks tick up. But then what do we see when we go 1 year out from the war? In all those instances, I know it was only a 5.5% increase in 2001, but the market is always up. And so the main takeaway for you out there with your longer term accounts, if you're close to retirement, you might have to sit through a little bit of pain, right? Some red. There might be more downside to come, right? That's just the reality. But markets are designed to go up. Markets have survived every war in history, and they will survive this one too. And if you just go back, and we'll look at this here on the charts in a second, because I'm going to pull up the charts, and then we'll take a look at some of your questions. But if you just go back, and I always bring this up, if you go back and look at the S&P 500 from its inception until today, what has it done? It does this. It goes up. You're going to have those periods of decline. You're going to have those drawbacks. You're going to have your bear markets, which are so short when you look at them in comparison to bull markets, right? And honestly, there are opportunities. There are opportunities to add to positions that you have, but don't buy into the fear. As uncomfortable as it may be to see the declines, and if it does intensify and things get worse, no, this has happened before in the past. It will happen again, and the market will survive, right? I feel like I need in the background now, I will survive. I promise I won't sing anymore. All right, so let me pull up the charts here real fast. I get a drink of water quickly. And I want to show you just what we're looking at here. Let me see here. Window. All right, bear with me. I'm not a live streamer. Window. There we go. See this? I think we can. Let me the water jug tonight. Ash. You guys can see. Little dip. No, Mike. In fact, I was gold short on oil, but I didn't. And I still think oil will pop one more time, and I will try to do that. But I did not buy the dip on oil. All right, the charts are shown. Sweet. All right. So let me pull this. I want to show you, what. So this is the S&P 500 right here. Here is the end of February, right? And this was Friday, February 27th. So this is when things are like, all right, we're probably headed into war with Iran. So you could see here. And if you just measure out from the all-time highs, which is right here on January 28th to the lows, you could see we were down about 9.77%. So not that full 10% correction, but that was a pretty drastic drop for a market. If you look at this, since Liberation Day and the tariff weakness last year has just been on tear. And so what's unique about this is the first decline in the markets in the S&P since Liberation Day last year. And if you look at this move that we had off of the ceasefire, you gapped up above the 200-day simple moving average and the 50-day simple moving average, which has only happened, I want to say, 3 or 4 times in the history of the markets. So that's a pretty significant move. And when we're talking about gaps, we just mean the price closed the previous day to where it opens the next. There's a huge space, a huge gap in between where the price opened versus where it opens the next, right? And then we could see here too that we pushed above the 100-day simple moving average, which is a significant price area because a lot of buyers and sellers are active at this area. And so you could see that we are not that far off from all-time highs again. So if positive news continues to come back into the markets, you will see all-time highs retested again, and potentially we shoot through them. And also too, we have a new round of earnings coming up. You're going to have all the big mega cap tech reporting. So this could be the start of another rally. However, it is all dependent on what comes out of the peace talks. So, we just have to monitor that. But the other thing that I want to show you too, 10% is nothing, right? That is not that's a textbook correction, and a market correction is anywhere from 10 to 20%. When you get lower than 20%, then you're in bear market territory. And what I want to show you is, so this drop here off of the tariff noise last year, that was 21%. But here's what a bear market's like. So this is a bear market of 2022. And you could see how this played out for quite some time, right? That was about 8 or 9 months. It was a 27% decline. And what happened here with this bear market? Well, you had inflation that was out of control. What did the Federal Reserve have to do? They had to hike interest rates. And oh yeah, there was a war between Ukraine and Russia that was happening. And that all played into this downturn. So this is a 27.5% bear market. The other thing that I want to show you is what happens when you have a recession, right? So you have to go back to the great financial crisis of 2008, right? This was the when everything was underwater with the housing market, and you could see the decline that happened over 50%. And you could see how long it took to get back to those highs in 2007. you'd have to come all the way over here to 2013. So that's why a prolonged conflict where oil prices stay elevated and inflation continues to climb higher and interest rates have to be increased and there's risk of a credit crisis, we could see something like this. So that's where the longer duration stuff becomes a bit scary. So just wanted to show you guys those things here on the chart, just show you where we are currently. Again, we are not that far off of the all highs. And so what you want to watch for here now that we're into these significant moving average areas is what do we do from here? Do we reject and come lower on some negative news here recently? What we would want to see is if we hit this 200-day simple moving average, if buyers step back in here and they push the price back up, then that would tell us that this 200 is now acting as what we would call a support. Okay. So if we come back down, this 200 has to hold. And what we want to watch, so if you're, maybe you don't have a trading view or follow the charts, but what you want to watch to the upside is if the price presses up into the 7,000 area and can break above it significantly, the market is a pretty good indicator of what is going to happen in the world. That would mean that the market is pricing in the really a positive resolution to this war, because the market is pricing things in 6 to 12 months from now that nobody's even thinking of. And it's crazy how that happens, but the market really does know all. So that is that's all I'm gonna give you for charting. But then I'll open it up for questions for you guys. And I do want to share this with you. I do have a free class that I'm going to be teaching on April 21st and 22nd. And it's called From Fear to Your First Trade. So anybody out there who is interested in learning how to trade the markets, day trading, swing trading, I'm going to be going into a strategy and a system to show you how to do that. So it's something I teach a few free classes every year. This is something different that I'm doing. I typically do a beginner's boot camp, but I wanted to do something focused on trading. So if you guys are interested in checking that out, that will be April 21st and 22nd. I'll be sending out some information to you guys about that. You can click the link that I put there in the chat to sign up for that. But what I'm going to do is open it up to questions for you guys. And I want to thank everybody for being here and talking war in markets. So I will take your questions. Mike says typical losers look like opportunities to me. There's definitely some good opportunities out there right now for sure, as beat up as things have been. And it's weird is there are some things that have held on pretty strongly in this market weakness. And there have been other things that have just been pummeled to the tune of 50, 60, 70, 80% to the downside, that you wonder when you're going to see a flip to being back risk on with those tickers. So there are definitely some opportunities out there. Yeah, Palantir has been getting crushed. And again, Anthropic has been a big player in not just the software taking a big hit. Palantir, I guess, is a software company, but Anthropic and what they've been able to do with the models has been challenging Palantir as well. So I think that's why you're seeing a little bit of pressure here recently to the downside on Palantir. Today's market has been a disruptor that we have not experienced in history. The market is clearly being manipulated like no other time. Yeah, I mean, Mike, 100%. I mean, there's definitely, insider trading has always happened. It's always been a part of the markets, but we're definitely seeing lots and lots of it right now, 100%. Some of these positions that are being taken right before market close, before announcements or tweets are being made, or before deals are being made. Yes, it is happening, and it is definitely not fair. Definitely not fair. Why can't we get that information, right? Will you try and buy before the resolution or after? So the way that I approach my investing, which is different from my trading, is I have the tickers that I want to buy, and I have mapped out in advance the areas where I want to buy them. So it just becomes a matter of patience. When I can have levels mapped out on something a year in advance, and I might be saying to myself, "Oh, it's never going to come down to this price level." But a lot can happen in a year's time. And when it gets there, it's like, all right, guess what? I'm buying today. Right. And so in downturns, I'll typically nibble, as I like to call it, buy a little bit of shares. And then when it really gets to the value area on a company that I really want to own, then I will load up on it if it's at a price that I really want to have it. Thank you, Paulo. You guys are welcome. Awesome. Thanks for joining the class. Is it worth shorting this market? It's going okay, but I need to tighten my risk management. The only thing I'm scared of is a tweeter situation instantly in the market. There's definitely opportunity to short the market. There's opportunity to short the market every day, just like there's opportunity to take it long every day. You do have to be sensitive to the fact that we are in a headline driven environment. And you're right. One bit of news, one tweet, even if it's fake and not real information, could get you stopped out. Or if you don't have a stop, can blow up your account. So it's more critical than ever right now. I see when you're shorting in this environment that your stop is that you have that stop set, just because you don't incur a loss that is difficult to come back from. But there's definitely opportunities to short out there. Again, like I was talking earlier, oil, I think, will be a good short eventually. Now, maybe I've completely missed the opportunity, but I could see one more spike in the cards before things are over. But these values and levels that oil is at right now is extreme, and it will not stay there. It's just probably the way that I will do it is with puts. I won't short outright shares on it, but I'll wait for a big massive spike, and I'll look to buy some longer dated puts to capitalize on some downside there. Matthew, all right, register for the class. Awesome. I will see you the 21st and 22nd. I appreciate that. And then a question here from Go Gators. So do you think we could see a good size dip? I do think there's a chance. You have a lot of people who are calling for a bear market here in 2026. And if historically you look at the midterm election cycle, it's the weakest time frame in a presidency. And so typically you will see a drawdown that occurs really starting around now in through the end of October, and then November is the start of the best 6 months in the market. That's typically when you see your rally. So anything is on the table. If this thing carries out longer term, if we see longer duration, I think we can see a pretty significant decline. But again, a lot has to go wrong and a lot has to continue to go the way it's going. But if this deal can get done, I think there are still a lot of tailwinds with AI and the productivity of that can push this market further. So, we will see. I just did a video this Sunday talking about Jem Kerson of Kai Volatility. He's a brilliant dude in the market, but he believes that there's a 25 to 35% bear market that's coming that will bottom sometime in October as a result of everything that's going on. And he feels like that there's a bigger narrative at play here, that this is almost a proxy war with other countries for the U.S. and that it's going to be prolonged and it's going to put pressure on things more significantly to the downside. But there's no way of predicting. I look at the charts and just try to read the charts in terms of where we're going. We've had a nice response here the last few days, but it has to be sustained, and that's only going to happen through a resolution. Ben, Asim has been shorting oil. Good for you, man. I'm glad to hear that. I hope you made a ton off of it. Ben says, my next goal is to learn about puts. Yep. I will teach you, sir. Last earnings led to sell-off due to CapEx spending. Do you think that will continue with CPI coming out tomorrow or other factors? I was just talking about that today with someone, that the last earnings rounds, we saw outstanding reports. We saw good earnings per share. We saw good revenue. We saw good forward guidance, but we didn't yet see AI resulting in revenue. We didn't see it creating profits. I think we are going to start to see that this time around. And I think the people are too premature to say, oh, AI is over, it's done. AI is just getting started. And take for instance, some of the responses we had off of earnings this last round, January into February. Any big, strong moves that you had after the report, they typically were gone within 1 to 2 days or a week. If you go look at Meta had a nice gap up on earnings, but then it sold off, gave everything back, and it just got pummeled here. Now, you want to talk about CapEx. They've been spending more than anybody in the AI space. And they had delayed their AI model, which they just announced 2 days ago that it's ready to go. It's going to be released. So I think it's those types of tailwinds and catalysts that are going to be hitting all at once. And oh yeah, you have the SpaceX IPO coming, that there's going to be a snowball that can really build some momentum and push this thing higher. So I do think this earnings round, because valuations were reset a bit with this correction that we had, I think there is room for these tickers to move higher and for these earnings moves to stick. But I think that there's going to be actual substance in the reports that really makes it credible that the moves can stick and hold, because it's backed up by the numbers. So I'm actually bullish on this round of earnings for the big boys, mega cap tech. They're going to dictate where the market goes. It's not going to be, the mid caps or small caps are going to drive it, but I do think you'll see some solid reports from the big guys. Yeah, sticking with the current goals, Ben. Yep, that's the way to go, man. No, I lost you. Hopefully you guys got me back. Did I disappear for a second? I'm back. Oh man, I gotta work on my live stream game. Sorry about that, guys. I start getting into this stuff. Start getting these questions. You guys got me all fired up here. Sorry about that. I hit a button on my mouse. See all that talk about CapEx and earnings and AI. All right, let me make sure. Let me hit these last few questions here and we'll wrap up. Yeah. Matthew says, or wait, student, there are other problems like the credit crisis. Yeah, private credit, inflation. Besides it, yep, inflation will uptick because the oil. Yeah, yep. The longer the oil's up, that is definitely going to be inflationary. Matthew says AI is just getting started, focused on memory and photonics. Speaking of charts, can you see us hitting the bottom of the SPX trend line before we get a recovery? I'd have to go look at the trend line that you're talking about. If you want to send that over to me, Asim, I'll take a look at that for you and send you a response. I think you have my email. Just shoot that over for me. I'll take a look at that for you. Oh, 5,600. Oh, that's a big drop. Never say never. Never say never. In mind the can't that software will survive and come back here. I think that some software will survive who is able to adapt and who actually have a product or service that can be augmented and strengthened by AI. It's those software companies whom AI can easily replace that just aren't going to make it. So to that, recently I just changed my large language model from ChatGPT to Claude. Oh my guys, if you haven't used Claude, and I hate changing, I'd never go back. It's amazing. So if you can, check it out. But just seeing some of the stuff that this thing can do, it's insane. So I think there are a lot of software companies in trouble. So again, the ones that it augments and enhances are going to be okay. The ones whom it just makes obsolete are in lots and lots of trouble. Yep. All right. Matthew says your live content is my favorite. Keep that. Thanks, man. I appreciate that. Any thoughts on quantum computing? I think it's years away. I mean, you have a lot of people who think that it's closer than a lot of people think, but I don't spend a lot of time researching that space to speak on it intelligently. So I don't want to sit here and act like, you do hear a lot of people saying that quantum computing will be able to break the security of Bitcoin. So obviously that they think it's going to be on a faster time frame than what it currently is. But I think we're probably still some time away from it. And then the last one's here. So Ben says major advantages of Claude. So just more balanced, more data to support the responses, and more human, if that is even possible with I know that sounds like paradoxical. Try it out. You'll see what I mean. Give it a shot. You might not like it, but I used it for a little bit. I was like, wow, this is all right. I'm convinced. So, all right, guys. Asim, thanks so much. Thank you, everybody, for joining me here tonight. This is a blast that I get to be able to do this and share my passion with the market. I hope you'll join me for that free class from Fear to Your First Trade on the 21st. And then I will be teaching a day trading class in May, so stay tuned for that. I might have some more live streams coming up. I appreciate you guys so much. Thank you for supporting the channel, and join me for the Jerome Powell Presser live stream at the end of the month. All right, guys, take care. Happy Thursday, and I'll see you soon.